Okay, let's start. So I'm talking about issuing debt, issuing equity, and all that stuff, but let's remember what those were, right? So when I say equity, I'm talking about common stock or preferred stock. Common stock is the regular stock the company issues. There are stockholders, they are the owners of the company. They're also called shareholders or equity holders. Shareholders, they're all the same thing. When you own a stock, you have a voting right. So you can vote on important decisions like mergers or on board of directors, election of board of directors or CEOs. And you have residual claim on cash flows. What does it mean? The company generates some money. First in line to get money is debt holders. They're getting paid first. Then preferred stockholders, then common stockholders. Why are debt holders getting paid first? Because if you don't get them, give them their money, you go bankrupt. You don't want to go there. So you pay back debt holders first. And when I said debts, we talk about it, but there are loans, bonds, notes. These are all debt instruments. And debt holders will get the money they borrow to the firm. That's it, nothing else. So you get some money and you pay back the money with some interest. And they have senior claim on cash flows. So they will get first in line to get their money back. What else? Preferred stock. What does holders do in the line of payment? But they generally don't have voting rights. Okay, so these are the general equity and debt ideas. With the common stock, it has some maximum number of shares it can sell to the public. And they need to get votes of shareholders for this maximum number of shares outstanding. Outstanding shares are the ones that are sold to the public. It is out there, standing. And there are some treasury shares, and you see it in the balance sheet actually as a negative item. What happens is the company buys back some of the outstanding shares. And it goes in as the treasury stock in the company. And together, they will all have the maximum number of shares is authorized shares. That's it. Par value of shares is the book value of shares, let's say. The company decides on it, but it has no economic meaning whatsoever, so you can forget about it. We already talked about the difference between book value and market value. Book value is in the balance sheet, shareholders' equity. It's recorded as the historical cost. Market value is price times numbers of shares outstanding. And some companies make dividend payments. Most companies make dividend payments. Some don't. And for the dividend payment, it is determined by board of directors. There is a declaration date of the dividend announcement. And they say, if you have the stock on or before the ex-dividend date, you're going to get the dividend payment. And then there's the payment date of the dividend. Dividend payment levels don't change much from year to year. They generally, in US, they make quarterly payments, quarterly dividend payments. And like really, you get check from the company. So suppose that you have 10 stocks of 3M. Every quarter, 3M sends you 10 stocks worth of dividends as a check. So you get the dividend payment. And stockholders can be common stockholders like us, like regular people, or there can be institutional investors. When I say institutional investors, I'm talking about pension funds, for instance. I'm talking about mutual funds, hedge funds, okay? And these are the big investors. They buy huge bulk of stocks from companies. We said common stock has residual claim on cash flows. But the good thing about being a stockholder is that when you're a stockholder, the maximum you can lose is the money you pay to buy the stock. But what is the upside potential? Suppose that you bought a stock for $40. What is the upside? Like what is the maximum money you can make on the stock? It's unlimited. Sky's the limit, right? So the stock price theoretically can go to infinity. So as a stockholder, you don't have lots of downside risk, but you have lots of upside potential. So are you okay with risk or not? Do you want the CEO take safe projects, or are you okay with risky projects? Is risk good for you or bad for you if you're stockholders? It can be good, right? Why? What is the good thing about gambling? You can make lots of money. And if you can make lots of money, your upside potential is limitless. You can get all that money from the company. I don't know whether I told you this in my previous class, but FedEx was having lots of trouble. And the CEO of FedEx took all the money. He went to Vegas. He gambled all the money, and he won. And FedEx is still around. Okay? So this is the risky behavior. This is a very, very extreme example, of course, but it's an example. So shareholders are actually okay with risk. Think about debt holders. Like, what kind of heart attack would a debt holder has when the CEO of FedEx calls him from Vegas telling him he's gambling all the money? So for debt holders, risk is bad. Why? There's no upside potential of debt. You know how much money you're going to get from the company. That's it, right? Company doing awesome doesn't mean anything to you. You just want the company pay back the original amount of debt plus some interest. That's it. Okay. When you look at common stock ownership of the US companies, you see 37% of the stocks are owned by households or non-profit organizations. But then we have institutional investors like mutual funds with 25%. We have pension funds like 17%. But as you can see, households constitute a large portion of stock ownership, and then we have institutional owners as well. And as stockholders, we are the owners, and we have a right in the management in the company. So we have the right to vote on changes in management or mergers and acquisitions or any other thing that shareholders has to vote on. Interesting thing is, this is not very common, but I find it kind of interesting. So there might be single class or dual class firms. So for some companies, they have different versions of stocks. Like Google has two types of stock. Stock A, Stock B. I think this is literally their names, Stock A, Type A, Type B. And the difference with those stocks is voting rights. Like I think Type B has 10 voting rights. Type A has 1 voting right.
Is it the same in Turkish stock exchange too? In stock exchange, like İşbank AB or Erdemir AB?
I actually don't know. I don't know. But it's really rare in US, so I would expect it to be rare as well in Turkey.
Because as I know, İşbank has 3 stocks, and Erdemir AB has also 4 stocks.
Oh, it might be the case. We should look into that. Okay, I'm gonna look into that. Thursday we can talk about it. Why do you think companies are doing it? Yes?
To keep in control of the firm.
Exactly. So they want to keep the stocks with high voting rights themselves, so that they're going to have a huge say on what's going to happen in the company. I mean, it's a good thing or a bad thing, because if those insiders are very informed, then they can make better decisions than what we think. But at the same time, it's a governance issue. Like, as stockholders, we don't have a say on what's happening in the company. Okay, preferred stock, we talk about it. This is also stock, but it is preferred. It has a dividend payment as well, like a common stock. They get paid before stockholders do. And if preferred stockholders are not paid yet, the company cannot pay any money to stockholders. But sometimes what they do is, if they're going to skip a dividend payment to the preferred stockholder, they give the voting rights, like as a consolation prize, let's say. So sometimes this can happen. Debts, there are many different types of debts. You can write lots of contracts on different debts. And you can find money the way you want in a well-functioning market. So what happens with debt is debt holders are not owners. Debt is debt. You know, they have senior claim on cash flows. That's it. And a huge right they have in their hand is bankruptcy. When the company cannot pay any coupon payments, it is actually a bankruptcy. So it's a huge deal for a company. And corporate debt holdings of US companies, they generally belong to insurance companies with 27%. Rest of the world. Who is this rest of the world for US? China. Yeah, lots of US debt belongs to Chinese actually. And households have only 15% or so percent of holdings in debt. Okay, what kind of debts? Let's talk about those very briefly. So first of all, maturity. Do you want short-term debts or long-term debts? You generally try to match your debt maturity to the project's maturity. So if you have a long-term project, try to find a long-term debt. It can be less than 1 year, more than 1 year. You decide on structure of payments. Are you going to pay back monthly, every quarter? You can decide on it. Fixed or floating rate. Do you remember corporate bonds? They have coupon payments. And if you remember, coupon payments are generally fixed. Like, I don't know, 10% coupon payments means for a $1,000 face value bond means you're going to get $100 every year. But this coupon rate can be floating. Sometimes they link it to LIBOR rate or the prime rate. And when those rate changes, the coupon rate of your bond changes. You can borrow in your currency, in any other foreign currency. You can have senior debt or subordinated debt. Senior debt is they have the senior claim, then subordinated debt holders. So you're going back in the line of getting cash flows. You might have secured debt or unsecured debt. How do you secure the debt? With collateral, right? So you say, I'm going to give you debt on your store, on your factory. So you can secure the debt as a debt holder. Covenants. Covenants are, so they're agreements, debt agreements, of course. And in covenants tells you what to do to the management. So they say, restrict the capital expenditure. Your debt ratio cannot be higher than this. Your net worth ratio should be this. You should do that. So they can put all those clauses in the debt agreement. So they're basically making the manager not move opposite of what their interests are. So they want the manager to protect debt holders' claim. And they can do it through covenants. There are straight bonds and convertible bonds. Straight bonds are regular bonds. Convertible bonds can be converted into equity if debt holders would like to do it. And they do this when there might be agency conflicts between shareholders and debt holders. So debt holders turn their bonds into equity. They become owners in the company. So as you can see, there are lots of different ways of mixing and matching all those things and creating debt agreements for yourself. But debt agreements are really serious business. So you have to be very careful about it. Because if you cannot obey the rules, then you're going to go to bankruptcy or you're going to violate a covenant. You will be in trouble. Any questions? Okay. Moving to different markets. You also remember those, I hope. There's primary markets and secondary markets. In the primary markets, this is the new issuance of debt or equity from the company to the public. So suppose that with Facebook, for instance, Facebook IPO, it was a private company. Then it became public by selling stocks to the stockholders. And this issuance took place in the primary market. And the money raised went to the company. It went to the Facebook, right? Facebook selling stock to the investors. In the secondary market, after the issuance, previously issued stocks or securities in general are traded between investors. So Facebook, sold my stock to Özüm. I got money from her. And then Özüm sold her stock. This happened in the primary market. Then Özüm sold her stock to Selin. It happened in the secondary market. Do I get any money? I'm Facebook. Do I get any money from their transaction? No. Then why do you care? Why do I care about secondary markets? Huh?
It represents market.
Reputation is definitely one thing, which is a signal of how well I'm doing. So if there's lots of trading, it means people are talking about my company. It's a good thing.
You may issue new stocks that will sell at that price, so it's important.
If things are going well in the secondary market, I can issue more stocks at a high price, yes.
It represents market.
Whatever happening in the secondary markets, it definitely gives an idea about how market values my company. And overall, for the financial market, it's awesome to have secondary markets because of liquidity, because of healthy function of financial markets. Okay, not only just a second. Not only the IPO takes place in the primary market, second time, third time, fourth time, I can issue equity to the public, and it's called seasoned equity offering. It also takes place in the primary market. Whenever I'm making the sale, the company or government selling bonds and getting the money, it happens in the primary market. Just like as a definition. Okay, yes?
I still didn't get why, as a company, I should care about secondary market, I mean, price of my stocks in the secondary market.
But it's the stock price is determined in the market, so it's important for me how well people are perceiving my company. So if there are lots of people who want to buy my shares, stock price will increase. It's good for me, right?
I'm not planning to sell the rest of my shares.
That's a good thing. Why, if people think the company is doing well, why are there people selling their stocks? Right? This is
I don't want to lose my control of the company, and I don't want to sell more than 51%, for example, and less than 50%.
you probably have less.
51%, and I don't want to sell the rest of it. So why should I care about my stock of my price of my stock in secondary market?
Okay.
Indeed, I would want to reduce the price because I would rebuy. I mean, for example, if I sell 10.
Oh, okay. No. You don't want to reduce the price of your stock at all.
For example, if I sell 10 TL
Uh-huh.
in IPO, and let's assume everyone bought it, and I can buy again if it is 7 TL. For 1 year later, for example, if price reduce.
And you're the owner of Facebook?
I would want this, yeah.
Okay, I understand, but as an owner of a company, you never want the stock price to go down. And
It's not my stock, it's in the public.
who are you? Are you the owner of Facebook or are you just an investor?
I'm the owner of 51% of the company.
So you're the owner of Facebook. So as an owner, how come you want the stock price to go down to 7? I mean, this doesn't go that way. I mean, the companies go public and then investors start trading those stocks between themselves. And as owners, I don't need to have 51%. Even if I have 1% of Facebook, I still want Facebook to do very well because the worth of my stock will increase. And I will get more money this way instead of waiting the stock price to go to 7 and buy more. Because in the end, you want the stock price to go up. So, right? No matter what happens, you want the stock price to go up. And it is important, it's an important indicator how people perceive how companies are doing.
I just wanted to say that when you issue 10 TL of stock,
Uh-huh.
before it goes down to 7, and you make a repurchase of these stocks, and you technically you make a 3 TL of profit because you made the issuance. And
You're not making profit though. You're going to make profit if stock price increases again. You're just buying and to you maybe undervalued stock.
But I understand this that important.
Okay, yes, we all understood it. We're going to talk more about stock repurchases and I will show you all the proofs and evidence on that, also how market reacts and stuff, and we are going to have a better understanding of things. Yes?
If the stock does extremely poorly in the secondary market, is it possible that debt issuers would stop investing, giving that to the company?
Exactly. There are actually studies which show that bad stock market response from investors will translate into bad bond markets. Why? Because when you think a company is in trouble, you don't want to give money to the company. So again, stock price is very, very important for all of us, for investors, for the company, for everyone in the market. Okay, and financial institutions, okay, financial intermediaries. We have banks, commercial banks, we have investment banks, we have insurance companies, we have mutual funds. Do you remember what mutual funds do? So basically what they do is, you want, okay, as Burcu Esmer, I want to buy some stocks, bonds in international markets, in Turkey, in US, everywhere. And instead of dealing with all picking stocks and assets and everything, I go to a mutual fund manager. I say, look, this is my money, create a portfolio for me. He gets some fee and he manages my portfolio for me. So he makes the diversification for me for a small fee. And they're hedge funds. Hedge funds have very, very risky portfolios, and only limited number of people can go to hedge funds. They deal with very high amount of money, but they're basically doing the same thing. They're picking stocks for you, but high risk stocks. If it is high risk, why would people put money in hedge funds? High risk means high expected return. Okay, so it's nice to have financial intermediaries for what? Think about how they make our life easier.
There's a more trust, liability.
Okay, things become more transparent. Yes. Yes.
A financial institution is probably more practiced and better at doing the risk diversification than an individual.
Exactly. We just talked about what mutual funds are doing for us. They are pooling risk. They're insurance companies. They are taking risk away from you, for instance. Another thing is we don't carry cash with us all the time. We use credit cards. Things get easier. You time travel money, right? If you don't want to spend money now, you put it in the bank. You get some interest. You use your money after 1 year, 2 years. And those financial intermediaries bring borrowers and investors together. I don't want to spend my money now. I put it in the bank. Someone needs the money now. He goes to the bank. So instead of me putting on a status update on Facebook, I want to give some money to someone. Instead, you just go to a bank. And banks handle everything for us. So these are all the nice things about having financial institutions. The bad thing is they're everywhere. And if there's something wrong in the financial system, the crisis effect will be even worse. So you need to have healthy, functioning financial institutions. Okay, now in the last part of the class, we're going to talk a little bit about what venture capital is, what initial public offerings are, what kind of sales can be made by companies, and what are private placements. And you already read the assignments, so this part will be very easy for you. So what's a venture capital? Basically, these are the companies which fund firms in the early stage of their existence. So think about a Silicon Valley firm. You have this awesome idea. You come up with the business plan, and you ask from your family's friends. You came up $100,000 or so, whatever money you can find, but that money is not enough. So what you do is you go to the venture capitals, angel investors, and you try to sell your business idea to them. And they take partnership in that, of course. So what happens is venture capitalists, if they think it's a good investment, they give money to you. They get percentage of ownership in the company. And generally after the IPO, they get their money and they go away. So venture capital market is really big in US. This is from 1995 to the current year. These are number of deals, and this is the value of the deals. As you can see, late 20th century, we see a spike in venture capital deals, and they're worth like $110 billion. It's huge. Of course, there was this tech bubble problem. After that, venture capital investment decreased, but it is still very, very high. And with that, when I say, oh, venture capital is awesome, they cherry pick those investments. They're highly specialized people. They know what they're doing. They give consulting during the process to the companies as well. But out of 5 investments, there are only like 1 big winner. So it's not very easy to figure out which one will be the winner. 2 of them will just return the initial investments. You're not making money, you're not losing money. 2 of the cases, you're going to lose money. So these are high-risk investments, of course, for venture capitalists. So the one that succeeds go to the next stage. Venture capitalists don't give the entire money right away to you. They give the money stage by stage. So if you are successful in the first stage, then they give you more money. So they're kind of hedging their risk, basically. And if the second, third stage is also successful, the firm goes and makes an IPO. And this is what happened in the Twitter case. I think Twitter was supported by venture capitalists. Okay, and when companies consider an IPO, what happens? Or before that, let's go to the reading material a little bit, because it's just about venture capital. Do you have it? Okay. I'm going to read a couple of sentences that are important. So it says the average one-day post-IPO return of venture-backed companies between early 2007 and 2012 was 18%, which is more than 3 times the return of companies that didn't accept venture capital investment. So basically it's trying to say if you have venture capital investment, your one-day return on the IPO will be 3 times more than an IPO without venture capital investment. And also it says in recent years, the 1-year post-IPO return of a number of venture capital-backed companies has exceeded 25%. So you're making 25% return on the venture-backed IPO return. And do you remember what kind of reasons this article tells you about why venture capital investments are that successful? So there are 2 IPOs, one venture-backed, the other one is not venture capital-backed. Why one of them is more successful than the other? Or at least this is what this article is saying. You didn't read it? It's here, the venture capital effect. Yes?
I think that the venture capital do is like they monitoring the company first, actually on behalf of the investors, so they give a valid opinion about the company, so the investor has a chance to use their opinion as a buyer.
I mean, these venture capitalists is almost like when I say angel investors, they're really like angels. So they help you every step of the way. And they are highly specialized people. Like they are generally like technology, they invest in technology companies. They understand the market better. They give consulting all the time. And they look at long-term returns, actually. They care about how the IPO will be, how successful this company will be. So the first reason this article says is they take long-term view when selecting companies. So they don't care about short-term profitability. They care about scalability. So they care about how much, in the long run, this company will make. Also, they say, second, venture capital set the stage for further growth by actively professionalizing the young companies in which they invest. So they give consulting and stuff every step of the way, which is also important. It's better than just taking the money and leaving, right? Those companies are giving consulting as well. And also, finally, it says, since venture capital tends to specialize and concentrate in a few high-growth sectors of the economy, they understand the portfolio companies and they understand the market better. And actually they say venture capital finance companies are half as likely to fail, 32 times more likely to be acquired, which is a good thing. Somebody believes you're worthy, that's why you're being acquired, and 805 times more likely to go public. So of course, like this is Ernst & Young's study, which is kind of advertising the venture capital, but we have those numbers. So after venture, you find some money from venture capitals, you can go, or without venture capital, you can go public. And why do you want to go to public? Because the money you can find from private people will be limited. When you go public, whenever you need money, you can issue security, you can issue debt. So you're going to have better access to both of the markets. And disadvantage about the IPO or going public is that there will be more regulations. Private firms, for instance, they don't announce their financial statements. You cannot find it anywhere. But when you go public, you have to announce your financial statements every quarter. So you have to be ready for this. Also, the expense of IPO is really high. We're going to talk more about it. And you have to be aware of what analysts are thinking about you or what stockholders are thinking about you. So when you're a private firm, you don't care about any of this. Like for instance, Gamma is a very big company. We all know it. Is it public? It's not public. They don't want to go public because of the disadvantages. Okay, so initial public offerings happens as a primary offering. Company issues new stock to raise capital. There might be secondary offerings where the existing owners might sell some of their equity. Generally, venture capitalists leave at this stage. And the cost of or before that, for the IPO, of course, there are investment banks, underwriters helping the company with going public. They think about the value of the stock. They think about the IPO price and everything. They fail most of the case. You read the Facebook and Twitter cases. IPO costs are really high. And for a, $10 million value of issuance, the direct cost is around 10% of the money. So whatever money you're going to create, 10% is the direct cost. Indirect costs, together with indirect costs, it's like 20%. So IPO is a very, very expensive thing. Cost of equity is very high compared to cost of debt. And after the IPO, if the company needs more money, there will be seasoned equity offerings. It also happens in the primary market. Again, seasoned equity offerings are also expensive, not as expensive as IPOs, but still expensive. And instead of every time registering to SEC and getting allowance from SEC, companies do shelf registration. So what they do is they file for securities that they are thinking about issuing in the next 2 years. So every time they want to issue securities, they don't have to go with the process all the time. So this approval is given to the company, and then the firm can use this approval in the next 2 years. So again, when the company needs money, they can issue securities. If you look at the cost of raising capital, as you can see, IPO's cost is very high. And then there comes the SEO's costs. Then we have convertible bonds. Then we have straight bonds. So cost of equity, cost of raising money through equity is really, really high. It's especially high at the IPO because it's the first time you're going public. Then we can have private placements. Sometimes companies don't want to go with public offerings. Why? They don't want to deal with legal stuff. They don't want to deal with registration fees or underwriting fees. They don't want to deal with stock price reaction. You saw what happened with Facebook. It went downhill for a long time. So sometimes companies don't want to deal with it. So instead, they go to private people, private investors, and find the money through that channel. Venture capital is also part of the kind of a private placement, actually. With this, only a number of knowledgeable investors are becoming investors in the company. There's no registration with the SEC. These are generally very well-known people, investors. They're not going to invest in every company, of course. You have to impress them. And there are restrictions on reselling those private ownership, let's say. This is like a very distinguished club, let's say, private placements. But the good thing is cost of private placement is very low. Not all private placements should be small. There might be very big private placements. But there are some legal expenses, and it's not very easy to find investors. And the last thing is, okay, so what happens is with the private placements, when a company needs small amount of money, this is what they do. They go try to find private placements. When the company needs more money, the company needs to go public. With Facebook case, I don't know whether you saw it, but before the IPO, I think it had like 500 big shareholders, and like by rule, it had to go to public. Like it came to a point where it couldn't find any money from private placements. It had to go to public. So now it's your turn. Let's talk about Facebook and Twitter case. Who wants to talk about Facebook? Like when did the IPO take place? Huh?
18th of May 2012.
May 2012. There were underwriters. The stock price reaction was really, really bad. If you remember, the first day reaction was terrible. The stock price went down for a couple of months, actually, maybe 6 months. Then now it's fine though. If you look at the stock prices now, it's really not bad. Do you remember what went wrong there? There were a couple of issues. What? They were registered with NASDAQ, and there was a problem with the NASDAQ system, so people didn't know whether they were able to buy the Facebook stock or not. So I think NASDAQ had to pay $10 million or something to investors because of that later on. That was one thing. There was another interesting thing, actually. There was changes with the earnings expectations of Facebook. Do you remember that? Before the IPO, those underwriters changed their, changed the documentation in the prospectus of the IPO, and they only informed some institutional investors verbally about this. So normal, regular investors didn't know about it. But it was a legal thing. So apparently, before the IPO, you're not supposed to change the statement, prospectus, but you can only do it verbally. And of course, those underwriters only pick the big investors to inform about the expectations of the earnings. So then what happened? Facebook raised like $100 billion on that IPO, actually. It was a really, really bad IPO. How about Twitter? What happened with Twitter? I think on the first day you made 75% money. Another thing with Facebook is they increased actually the order before the IPO. They wanted to sell some amount of stocks, then they increased it because they thought there would be lots of demand. It also affected the situation. With Twitter increased the price that they had in their minds before the IPO took place. You were going to say something?
I was actually going to ask something, maybe other people can confirm. Both of these IPOs are firm commitments.
What do you mean, firm commitment?
The underwriters take all the risk, and
Yes.
if the price goes above the initial offering price, it's the underwriter that actually benefits from the change. In that case, some of the articles I read were that Twitter was actually a failure for the company because the offering price was only somewhere around $25, $26.
Yes.
Whereas the opening price for the stock started from $49. So most of the benefits actually went to the underwriting company, which was Goldman Sachs.
Do you see the problem here? There's like, it has to be underpriced. Why? If it is overpriced, nobody will buy those stocks. That's why underwriters are actually underpricing the stocks because they don't want to be stuck with all those stocks because they're taking all the risk.
I also read very similar things.
Uh-huh.
And he also said, the writer said, Goldman Sachs always doing the same thing with the IPOs. They're always giving high price,
Mm-hmm.
overvalued prices.
Uh-huh.
That's the case, I think, or Morgan Stanley. I'm not sure. And one of them, IPOs was Morgan Stanley, and another one was
Goldman Sachs, yes.
And they also blame to underwriter company, underwriter banks in
Mhm.
the Facebook case.
This is generally the rule. I mean, in the IPO, you can make money, but not in the long run. I think it's a profitable thing for 6 months if you keep it for 6 months. But in general, if you look at long-term performance of IPOs, they're generally bad. Why? It's because of the market conditions as well. When the market is doing well, you see lots of IPOs. And when the market is peak, you see IPOs. Then, of course, things will go bad for all the companies. So IPOs will also look bad in the long run. So in maybe short run, you can make money, not all the time. So as you can see, with all the things we talk about, there is not one side of the story. Okay, the same. This is same with IPOs, same with all kinds of corporate decisions. So in this class, I will just think about the intuition and what can go wrong, what is good, and this is just the I don't know, introduction to this class, how things will go. We're going to go into more mathematical stuff on Thursday. We're going to start capital budgeting things. And I'm going to put slides tomorrow. If it's not already there, I will put the slides tomorrow. And I will see you Thursday if you don't have any questions. Don't forget to submit your homeworks.